Right now, while you're watching this, over 11,000 banks are quietly switching to a new global messaging standard. Not next year, not someday, right now. And 3 crypto networks, XRP, HBAR, and Stellar's XLM, are among the only assets on Earth actually built to plug into it. Nobody on mainstream financial news is connecting these dots, so let's connect them, together, with actual data, not hype. If you're new here, hit subscribe, because what I'm about to show you changes how you should be watching the next 90 days. Let's start with a date almost no retail investor has on their radar, November 2026. That's the final deadline for the full global migration to ISO 20022, the new universal messaging language for cross-border payments. Here's why that matters. For 50 years, international banks have communicated using SWIFT's old MT messaging format, clunky, limited, and basically a fax machine compared to what's coming. ISO 20022 replaces it with rich, structured, programmable data, which means banks need infrastructure that can actually speak that language in real time. So here's the question nobody's asking: which networks are already ISO 20022 compliant today in production? XRP, XLM, and now increasingly, Hedera's HBAR ecosystem through enterprise partnerships. That's not a coincidence, that's design. But here's what nobody is talking about. Compliance with a messaging standard doesn't automatically mean banks are using these networks for settlement. There's a real difference between compatible with and chosen for. We'll come back to that gap later because it's the single most important distinction in this entire story. Before we go further into crypto, we need to talk about the machine that controls all of it, the Federal Reserve. Here's where we stand. Inflation has cooled from its 2022 peak but remains sticky above the Fed's 2% target. The Fed has spent the last 2 years threading a needle, trying to bring rates down without reigniting price pressure. Every single rate decision moves trillions of dollars of liquidity in or out of risk assets. And crypto, historically, is one of the most liquidity-sensitive asset classes that exists. Look at the pattern going back to 2019. When the Fed cuts rates or signals an end to hiking, capital rotates out of cash and bonds and into risk: tech stocks, small caps, and crypto. When the Fed holds firm or signals higher for longer, crypto typically chops sideways or corrects. So what if everyone is missing this? The next 2 to 3 FOMC meetings matter more to your portfolio than almost anything happening on-chain. A dovish pivot with confirmed cuts could be the single biggest tailwind for XRP, HBAR, and Bitcoin this cycle. A hawkish surprise could do the opposite. This is why smart investors track 2 calendars simultaneously, the FOMC calendar and the regulatory/adoption calendar. Most people only watch one. That's a mistake. Now here's where it gets interesting. For years, XRP traded under a legal cloud. The SEC's case against Ripple created a psychological ceiling. Institutions wouldn't touch an asset with unresolved securities law risk, no matter how good the technology was. That legal overhang has substantially cleared. Courts found XRP itself is not inherently a security in programmatic secondary market sales, and Ripple has continued expanding regulated products, custody, stablecoin infrastructure, and cross-border payment corridors, while operating under U.S. money transmitter licenses in most states. But here's the part almost nobody frames correctly. Legal clarity doesn't create demand. It removes a barrier to demand. That's a crucial distinction. A bank doesn't adopt a settlement asset just because it's legal. It adopts it because it solves a cost problem, a speed problem, or a liquidity problem cheaper than the current system. So the real question is XRP actually solving those problems for real institutions at real volume right now? The honest answer, partially, and growing, but nowhere near full global settlement scale yet. Ripple's payment network processes real cross-border volume through on-demand liquidity corridors, but it remains a small fraction of the multi-trillion-dollar daily SWIFT flow. That gap between proof of concept and global default is exactly where the next 12 to 24 months of price action will be decided. Let's talk about the word every institution is obsessed with right now: tokenization. BlackRock CEO Larry Fink has publicly stated that tokenization of real-world assets, bonds, funds, real estate, represents the next generation of markets. BlackRock's tokenized money market fund has already accumulated hundreds of millions in assets on public blockchains. Boston Consulting Group has previously projected tokenized assets could reach into the tens of trillions of dollars by the early 2030s. Even conservative estimates put it in the trillions this decade. Here's the real story that gets even crazier. Tokenization needs settlement rails. It needs networks that can move value 24/7, instantly, with programmable compliance built in. XLM's Stellar Network already powers real tokenized asset pilots with global financial institutions. HBAR's Enterprise Governance Council includes major global companies experimenting with tokenized real-world assets and CBDCs. XRP's ledger has its own native tokenization and DEX infrastructure already live. None of these networks are guaranteed to win this. This is not a leaked secret. It's a public, competitive race, and traditional players like Ethereum, private bank consortiums, and even new SWIFT-linked blockchain initiatives are also competing for this exact same infrastructure layer. What if everyone is missing this? The winner of the tokenization infrastructure race may not be decided by retail hype. It'll be decided by which network institutions quietly choose for pilot programs that scale. Here's a twist most XRP bulls conveniently leave out. SWIFT hasn't been sitting still. SWIFT has been actively testing its own blockchain-linked infrastructure and digital asset settlement experiments with major global banks, explicitly to avoid being displaced. This matters because the popular narrative, SWIFT is dying and XRP replaces it, is an oversimplification. SWIFT controls the world's bank relationships and compliance rails. It's far more likely SWIFT evolves and coexists with new settlement technology than gets wiped out entirely. The more nuanced and more likely outcome, crypto rails like XRP, XLM, and HBAR become plumbing underneath or alongside systems like SWIFT, not full replacements. That's still enormously bullish if it happens at scale. But it's a very different outcome than XRP becomes the new global reserve settlement asset overnight. Manage your expectations against the data, not the hype. Let's move from macro theory to hard-on-chain behavior. Historically, large XRP wallet cohorts have shown accumulation patterns during extended price consolidation phases, a pattern seen repeatedly in past cycles, including before the 2017 and 2021 rallies. Exchange reserve balances for XRP have generally trended downward over multi-year periods, consistent with long-term holders moving supply into self-custody or cold storage. For Bitcoin, long-term holder supply, coins that haven't moved in over 155 days, has remained near cycle-high levels through 2025 into 2026, a historical signal that's preceded major bull phases in 2016 and 2020. For HBAR, network transaction counts and enterprise-related on-chain activity have shown consistent quarter-over-quarter growth as more council members deploy production use cases. Now, I want to be completely honest with you here. On-chain accumulation data does not guarantee a price move. Whales can accumulate for years before anything happens. Diamond hands can turn into exit liquidity if the fundamental thesis breaks. But here's what nobody is talking about. Accumulation during fear, combined with clearing regulatory overhangs, combined with real infrastructure deployment, is historically the exact setup that precedes major re-ratings. Not always, not guaranteed, but historically more often than not.